Good morning. For today's discussion, we will be having the financial statement analysis as a continuation of our previous topic. Now, at this point, you have learned how to identify and classify accounts and most especially prepare financial statements. Now, what is a financial statement analysis? How does it work? And how important it is for a business? Now, let's define financial statement analysis. It is the process of analyzing a company's financial statement for decision-making purposes. Now, this is also used to understand the overall health of an organization as well as to evaluate the financial performance and value. It also evaluates the past and project the company's future performance. Managers, investors, shareholders, or other individuals uses the financial statement for various information. How do we analyze financial statements? We have here three common techniques in analyzing the financial statement. First is a horizontal analysis, second is a vertical analysis, and third is a ratio analysis. Now let's have the first technique. We have here the horizontal analysis, or what is also known as the trend analysis. Okay. Um, It shows the changes in the amounts of corresponding financial statement items over a period of time. Now, it is also used to see if any number are unusually high or low in comparison to the information for bracketing periods, which may then trigger a detailed investigation of the reason for the difference. It can also be used to project the amounts of various line items into the future. Now, let's take a look at the formula. We have here two formulas for the horizontal analysis. First off is the amount change. So, amount change is equal to the amount of the item in comparison year less the amount of the item in the base year. Okay? Next, we also have the percentage change. Now, in the percentage change, it is equal to the amount change divided by the amount of the item in base year multiplied by 100 to get the percentage change. Have an example of a horizontal analysis. Now, since we're comparing the figures for this analysis, we must have at least two accounting periods. Now, it could be a month, a year, or a quarter. Now, for this example, we will examine the De Leon Corp with two accounting years. Okay. Now, in this example, you can already see the increase or decrease amount or percentage. So here is the amount change and the percentage change for the De Leon Corp's balance sheet. Now let's take a look at an example on how we compute the amount change and the percentage change. Okay, let's have the cash account. Okay, first is we should get first the amount change. So the amount change is equal again to the amount of the item in comparison year. That is the year 2002, and then the amount of item in the base year, that is 2001. Now let's change it into figure. Amount change is equal to 7,282 less 57,600. So we have here the amount change of 50,000 negative 50,380. Okay. Now let's get its percentage change. Now for that, we should have the amount change, which is a negative 50,318 divided by its amount of the item in base year multiplied by 100. So this is it. And then we have here the percentage change of negative 87.36%. That is here. Okay. Now, after computing the horizontal analysis for the Leon Corp's balance sheet, we can now have the several conclusions on what happened to the firm in a span of 2 years. Now, for one, we can conclude that the firm has implemented some expansion plans, which can be seen in the increase of its total assets. Here, you can see that there is a significant increase in its total asset, considering that it is up by 95.17% for 2002. And it complements with increase in its total liabilities, which happens to be 194,000.90%. So it means that the company or the firm has done a lot of financing activities for year 2002. Okay, now let's proceed to the next technique. We have here the vertical analysis, which is also known as the common size analysis. Now, in this technique, each item in the financial statement is shown in the percentage of the base figure. Okay, now in this method, it compares different items to a single item in the same accounting period. So, unlike the horizontal analysis, it compares figures in two accounting periods, at least two accounting period. Here, in the vertical analysis, we are only comparing items in the same accounting period. Now let's have the formula for this. We also have two types of vertical analysis. The vertical analysis for the income statement, which is equal to the income statement item divided by the total sales as the base figure multiplied by 100. We have here also the vertical analysis for the balance sheet. Now it is equal to the balance sheet item divided by the base figure, which is the total asset or the total liabilities and owner's equity, multiplied by 100. Okay, now let's have an example of a vertical analysis. Now, in this example, we will be using the comparative income statement of De Leon Corp for years ended 2001 and 2002. Now, here you can see the percentage for the vertical analysis or the common size analysis. Now, let's have a sample computation for a specific account, and let's have the cost of goods sold account. Now again, the formula for the vertical analysis is income statement item, since we are using the income statement of De Leon Corp, divided by the total sales as its base figure multiplied by 100. Now here, since the income statement item that we will be using is the cost of goods sold, so we have here the 5,528,000 divided by 6,034,000, that is the total sales for 2002, multiplied by 100. So we have here the 91.61% cost of goods sold based on its total sales. Okay, so what does this 91.61% mean? Now, this means, it basically means that the Leon Corp are spending much on the cost of its product. And by looking at the two comparative years here, the 2001 and 2002 and 2001, the cost of goods sold has increased on the year 2002. If you can see here, for 2001, the cost of goods sold is only 83.45%. And then in 2002, it increased to 91.61%. So it could mean, or basically, which it could mean that this account could be the main reason why the firm has a net loss for year 2002. Okay, so we have here the last technique, which is the ratio analysis. Now, ratio analysis is a quantitative method of gaining insights into a company's liquidity, operation efficiency, and profitability by studying its financial statement, such as the balance sheet and income statement. Now, this technique is widely used by investors who are using the fundamental analysis in studying a certain blue chip companies. Now, this can also mark how a company is performing over time while comparing a company to another within the same industry or sector, in which we also call that the industry analysis. Okay? Now, in the next presentation, we will dig deeper on the different types of ratio analysis and its implication to the company's financial health. So for now, that's all for the introduction of financial statements. So again, thank you so much and keep safe.